Hello, my name is David Garcia. I'm a CPA, CFP, and partner at Evensky, Katz Financial. Today I'm going to be talking about capital gains and how other types of income can affect your capital gains tax rate or bracket. For a long time, capital gains taxes were pretty straightforward. If you bought an investment like a mutual fund or real estate property and held it for more than a year before selling it, you were taxed at a preferential rate. In recent years, changes to the tax code have added capital gains tax brackets, 0, 15, and 20%, similar to ordinary income tax brackets. In addition, a Medicare surtax can add 3.8% to the 15 and 20% capital gain brackets for taxpayers that exceed a certain threshold. Unfortunately, the complexity doesn't end with the brackets. Most people have capital gains along with other sources of income like wages or Social Security. Once you have more than one source of income, it can affect where you end up on the capital gains tax brackets. This has to do with the IRS ordering rules for income. The rules require that ordinary income, like wages and Social Security, less deductions, come first to arrive at taxable income. Taxable income is then run through the higher ordinary income tax brackets. After that, capital gains are added to taxable income to see which capital gain bracket to apply. This doesn't mean that ordinary taxable income is taxed twice. The ordering rules just stack the capital gains on top of the taxable income for purposes of determining the capital gains tax rate. Here's a simple example. John and Jane are retired. They file married filing jointly and have $50,000 of ordinary income and $70,000 of capital gains. They opt for the standard deduction, which in 2020 is $24,800. First, the $50,000 of ordinary income less the standard deduction is applied to the ordinary income brackets. The $70,000 of capital gains is then added on top of the $25,200, which results in the $70,000 of capital gains being taxed across the 0 and 15% capital gain brackets. If John and Jane had no ordinary income after deductions in 2020, all of the capital gains would have been taxed at 0%. From this simple example, you can see how ordinary income can potentially crowd out the 0 and 15% capital gains brackets and push up your effective or average tax rate. This can affect decisions around what type of income to take in a given year. If you have little ordinary income, you may want to take capital gains instead of an IRA distribution to take advantage of the 0% capital gains tax bracket. Or when considering a Roth conversion, the interplay of ordinary and capital gains may affect your decision. Bottom line is, failure to take into account this interplay between different types of income can result in needlessly paying more in taxes. So next time you have a decision between taking income early or later, or a discretionary IRA distribution or Roth conversion, be sure to consult your E&K FF tax advisor.